this section I'm going to talk to you about essentially the property strategies we have. As you're probably aware, we do strategies like discount or existing properties, we do renovation, off the plan, we do subdivision, strata subdivision, and can help people understand how to do a small development if that's their cup of tea. So what I'm going to do is sort of reframe the way we would like the business to unfold, and really it comes down to the automatic acquisition plan. The automatic acquisition plan is the key. What we would like people to do is at least own 5 pieces of real estate before they get into really doing a strata subdivision or a subdivision or a small development. We feel the 5 strategies or 5 properties that they should strategies that they should use for their first 5 properties is existing property in a growth market, is properties essentially that they can buy off the plan in a market which is poised to grow, or the third strategy is to do a renovation and get a bit of a discount on the way in. Okay, so they're the strategies. This is how I pitch it, so we'll take it from here. When to invest. After expansion comes contraction, but after contraction comes expansion. That's just the way the market moves. Let's take a look at the market. The market goes through peaks and troughs, and essentially during that time we've got an opportunity, if we buy at the right time, to get the best capital growth. Okay, at the top we've got boom. Who wants to buy in a booming market? Yeah, no one, right? What about in a market which is going through a bit of a slide? Absolutely not. Markets trough and they reach the bottom. And this is called opportunity. Opportunity markets are risk markets. Okay, why are they risk markets? Because quite often you don't know when they're going to leave opportunity or how long they're going to sit at the bottom of the market. Today Brisbane is at the bottom of its market cycle. It is a risk market in the aspect that we don't know when it's going to grow again. Indications say 2013, but for that it is a risk market. But it is also an opportunity market because property prices are now the cheapest in Australia. Okay, so you've got to weigh it up. The last 2,000 years is a mixture of opportunity versus adversity. Who makes more money, rich people or poor people? The answer, of course, is rich people. Rich people tend to like opportunist markets. That's where they put their money. That's where their money ends up rolling into. Value markets. Value markets are the easiest markets to pick. Typically what's happened if they've grown already, and you've seen a 10% capital growth hit the market, and they've hit the market and grown. And so they're generally the nice and safest markets for investors to get into, especially if you're doing your first, second or third deal. They're anywhere in this section is where we want to buy. This is our buying market. At 10 o'clock we've got hot, and if we want to sell, this is a great time to sell. Okay, so we want to buy down here and sell up there. What typically happens is during a 3-year period, house prices rapidly grow. Okay, they go up in value. If you buy a property down here at 300,000, by up here, it's liable to be up around the $450,000 mark. It grows. It doesn't double in value, but it grows. And that's over a 3-year period. Over here, we will sit flat for around 5 years. Your goal as a property investor is to buy in this market, make some money, make some equity, remove that equity in the form of being able to service it, get ready to buy another property in a market that's doing this, hold the property over that 5-year period, because it's going to be flat, it's not going to be enjoyable, you're not going to like owning it during this time, but you're going to make your money here. Then what you're going to do, you're going to see that market have another spurt after 5 years, and your property will double at that point. Double at that point. it goes around the economic cycle and has to hit that point a second time. And at that point, you're starting to make real good money out of the property, and the yields start to grow and be very supportive of really neutrally gearing the property. You won't have to outlay a lot of money. But the point is, you don't want to buy here and you don't want to buy here. You want to be buying around this period. Value or opportunity, because you're going to have the biggest lifespan on the property cycle. So now we understand where we should be buying. We understand what part of the property cycle we should be looking at. Okay, so now we've got to look at our life and what we're going to be able to achieve and how many property cycles we're going to live for. Because the ultimate goal is to have a property portfolio that is sustainable for a long period of time. Okay, and so really we break it down, or we're breaking down our process over 3 stages. The first stage is acquisition. Okay, acquisition. And the way I like to prompt it is, who in the room has one property? You are in acquisition. You need to buy more real estate. You need to have more exposure to the market to make more money. The compounding effect of real estate is brilliant, but you need to get involved with it. You need to buy more real estate. Who has 2 properties? 3? All right, who has less than 5 properties in the room today? You will find that 95% of the room put their hand up. Okay, you guys, you 95% of the room are now in acquisition period. These are your strategies in acquisition. Off the plan. Cosmetic renovation, growth, and that can be achieved through existing property, or it can be achieved through buying property, getting a bit of a discount on the way in. They are your acquisition strategies. Your consolidation strategies I will get into. The other phase of your life is legacy, and I'll talk about that soon. But legacy to most people is being able to set up a retirement and being able to fund a legacy after that for children, to be making sure people, friends, family are well kept after. Okay? But sometimes I find that people jump into what I call consolidation or trading too early, and they haven't really built up a foundation of 5 properties. And really the automatic acquisition plan needs to put at least 5 properties into your portfolio, and I'll show you how that looks soon. But let's just take a look. If we go to the acquisition strategies, discount or existing, renovation or off the plan, and we apply it to the market, would it be a good idea to buy off the plan where the property clock's at 1, start of a slowdown? You know, Melbourne's at the start of a slowdown today. Would it be a good idea to buy off the plan a unit in the middle of the city in Melbourne today? Absolutely not. What about to do a renovation? Perth's at number 5. It's at the bottom of the market. We know, or nearing the bottom of the market, and we know the bottom of the market essentially is a risk market. Would it be a good idea to do a renovation over in Perth today? Spend 20-30 grand on a new kitchen, new bathroom. Sure, I'm generalising, but we could seriously overcapitalise and not get our money out of that market quick enough. Remember, we want to buy in that sort of 3-year market upswing, and that's where we want to put most of our money. Okay, and what if we just bought a property at a discount? You know, where in that market is that discount? Okay, would it be a good idea to get a discount in a market which is slowing down? Okay, and there are markets out there right now you can get 20, 30, 40% off real estate, but they're going to slow down. Okay, so you just need to weigh up what you're doing.
Action.
So the automatic acquisition plan, AAP, traditionally what we've said is pretty simple, but now after and what we said is, buy 10 properties over 10 years and you'll have a pretty good, healthy portfolio. But actually, Positive Real Estate's now been trading for just under a decade, and we've seen some fantastic results. So you can say this, and I've checked with our finance department, and they are seeing this occur. So here we go. Guys, 25% of our clients, 25% of our clients now have property portfolios of 3.6 million with $1.8 million worth of equity in the middle, and a neutral to positive cash flow outcome servicing those loans. Okay, who likes the sounds of that? If that's the worst we did in real estate, would that be bad? Absolutely not. What have they done? Well, most of our clients have gone through acquisition. Okay, you need to build up a base of real estate. You're all in acquisition, and I will get to trading because most people love the idea of doing a strata, or love the idea of doing a subdivision, love the idea of doing a development. Okay, if you don't know real estate and you haven't owned real estate and you don't know what it feels like for a tenant to not pay rent for a month, or for a renovation, unexpected renovation or improvement to the property being needed, there's no point in jumping out and doing a development, right? I've seen too many people go to a 3-day course and get encouraged to become a property developer, yet they don't have this. Okay, this happened to me, it will happen to you. Okay, 25% of our clients in the mentoring program are now millionaires, property millionaires. Okay, so simple strategy: get yourself up to 5 properties. Okay, and you will be able to follow this. It may take time. We will do our best to speed this up by buying in that 3-year period where you're going to get growth. You then need to follow that market for 5 years and allow it to get into this second section of capital growth. And you'll end up with a really handsome property portfolio. And this will be the basis for a long and happy retirement, because for most of us, how many property cycles are we going to live for? We know that property cycles go for 7 to 10 years. How many property cycles are we going to live for? Okay, we know that property doubles every 7 to 10 years based on history. So if we can get ourselves 5 properties, and we can do it in 5 years, we could hold them. That would be our acquisition. We'd have one all around the country. We'd end up, after 10 years of doing this, okay, at $3.6 million worth of real estate, 1.8 worth of equity, and neutral to positive cash flow. That's the worst we did. How good would that be? And that's happened to 25% of our clients. How good is that?